So, shifting gears now, going up and thinking about the City of London, these banks, what is going on with these banks? Forget about Argentina, forget about the US, okay? What's going on with these banks? These banks are looking at bills that are coming in and they're saying, that looks like a good one, I'll discount that one. And they're sending out notes. And then they're having bills that are maturing and the notes are coming in. And so they're watching the liquidity flow, the cash flow in, the cash flow out. Okay? And they are taking on liquidity risk in doing so because they're discounting bills, okay? And they're not going to get money for 90 days. Okay? So they're basically lending long and borrowing short, like banks do. They're taking on liquidity risk. Okay. So they're acting as dealers too. So there's another kind of dealing that's going on, and this is in interest rate space, not exchange rate space. Okay. And we've seen this diagram sort of before, where we have an upward sloping yield because it's not in price space but in yield space. The bid offer curves slope up, and the outside spread here, this is bank rate. Okay, so let me just now remind you, we've talked about this before, but I'll just remind you. So the banks are doing this discounting business, okay? And when they start to feel like, you know what, I'm losing cash more rapidly than it's coming in, I'm a little worried, I'm taking on too much liquidity risk, what do? How do they control that? They control that by raising their discount rate, okay? Saying it's going to be, I'm going to discount by more, okay, than before. And so making themselves less attractive as a discount counterparty. So fewer bills come in to be discounted, more so the cash inflow exceeds the cash outflow, and they restore themselves. All individual banks are doing this in competition inside the City of London. But if they all start to run into troubles of these kinds, all the discount rates are going to rise in general. That's the market rate of interest. The market rate of interest is here. Sorry. The market rate of interest is this sort of bid-ask spread here, okay? Depending on the liquidity risk, okay, that is happening in the private banks there, how much they're worried about the disjuncture between their cash inflow and their cash outflow, okay? So I've told this story before where as the disjuncture gets worse, okay, market rate is bid up, and eventually they hit bank rate, which is the rate that the Bank of England quotes. And the Bank of England quotes, and it says, if you need a lender of last resort, you can always bring your bills to me, and I will rediscount them. I will give you notes for them. Okay, so the Bank of England acts as the lender of last resort in this regard. And so let's bring the Bank of England into the picture. If the pressure on the private profit-making banks gets too much, so we're moving out here, okay, and so price gets up here. We hit the Bank of England. These banks are willing to do this business, just like other dealers, because there is this outside spread. They know that they can depend on the Bank of England. It's there. It's saying that it will discount. And what does the Bank of England do? The ordinary banks can go to the Bank of England and say, please, we want to replenish our liquidity. We want to take some of the bills we're holding and cash them in and get some notes, please. Okay? That the Bank of England, the banking department has these notes as its own reserve, and it can pay them out. Okay, it can also say, well, you know what? why instead of taking notes, why don't you take deposits? Okay, it can expand its balance sheet on both sides, and as long as the banks are willing, as long as the dealers and banks are willing to accept deposits as if they were notes, the Bank of England can economize on its own note issue. This is another way. We talked about that as an internal drain. Okay, if there's just an internal drain, the Bank of England can absorb that by expanding its own balance sheet. And that keeps interest rates from rising above bank rate, okay, because it's willing to discount at this rate at a time when all the other banks are saying, I got enough liquidity risk, thank you very much, I don't need any more on my balance sheet. And so the Bank of England moves that onto their balance sheet. Okay. But what's new today that was not true in Lecture 10 is that we're talking about an external drain, not an internal drain, an external drain. An external drain is like this. I showed you here what happens if the dollar gets bid down, okay, to the gold point, then the central bank of the United States has to come up with gold, okay? But what about on this other side here? What if the dollar gets bid up to this point? What is this outside spread? Here. That's the Bank of England. That's the Bank of England, okay, there, making that market. Okay. So the surplus, it's the surplus dealers who are collecting notes and saying, you know what, I have too many notes, I want gold for them. I want gold for them, okay? And what happens then? What happens then, so this is the banking department. In the issue department is you get minus notes, minus gold. That's what it means to be, that's mint par, right? You're just as we showed for the Central Bank of the United States. They're defending now the pound sterling, defending the pound sterling by paying notes in gold on demand. But the Bank of England doesn't have an unlimited amount of gold. Okay. So what can it do? The same things that other central banks can do. It can try to acquire additional reserves. Okay. How does it acquire additional reserves? So this is one. Okay. Additional reserves, it can do some equivalent to selling treasury bills. It can raise bank rate. Okay? Raising bank rate, remember, it's raising bank rate at a time when everyone is coming to the Bank of England for discount. So raising bank rate raises the interest rate in the world. This is the world rate of interest. And it says, we're going to make it a lot more painful for you to bring your bills here for discount. And so you're going to want to repay the bills you have and not renew them. Okay? That should lead to a gold inflow, to a net gold inflow into the Bank of England, and therefore save them from having to repay their notes. Gold is coming in. Gold is coming in. People need to repay. Okay? Now, raising bank rate can cause other kinds of problems, make other people go bankrupt and cause further problems. So the third, the nuclear option, okay, is suspending payments. What does that mean? That means saying, I'm no longer going to pay notes in gold. I know I said that that's the mint par, okay, but it's temporarily suspended, no more, okay? I'm quite happy to give you sterling deposits. I'm quite happy to print more notes for you, okay? But I'm not happy to convert these into gold, okay? And so when the central bank of the world, when the crisis, when the imbalance of payments gets large enough, if it's the central bank of the world that's acting as lender of last resort, the last resort they have is to say, okay, this is now a pure credit system, and we're going to suspend specie payments for the time being. Okay, that's the nuclear option. Now, other banks can do that too, and then they drop out of the international system. When the Bank of England does it, they don't drop out of the international system. They are the international system. Okay, people keep going on using sterling as their international reserves. It's just no longer attached to gold. And then later on, when the crisis is over, maybe decades later, okay, maybe they return to gold and try again. Okay. This is how the gold standard works to police the, as a disciplining device for the payment system internationally, the international gold standard. And so notice the difference between Lecture 10 and Lecture 18, okay? That where in Lecture 10, we were really thinking of the Bank of England, or whatever the central bank, as being at the very apex of the system, and so it can just print money. There is no run that it could possibly ever have any trouble with, okay? Because the domestic currency is pound sterling, okay? But internationally, that's not true. An external drain, the bank has to respond to that, okay, by defending its gold reserves, okay, by raising bank rate, which could wreak havoc for your domestic economy. Note this. This is raising bank rate to do what? To do what? To defend yourself against this. These foreigners have done their banking business in your country, okay, and now you're having to raise domestic interest rates, okay, because there's this imbalance that's happening with cash flows as a consequence of making those loans. And if you don't do that, okay, your only other choice is to suspend specie payments, because you'll soon run out of gold. You'll soon run out of gold.